It's Wednesday morning, December 17th, 2025, US time. Let's start by reviewing Tuesday's close. The market didn't break, but cooling at high levels became obvious, and structural divergence intensified. Money didn't leave, it rotated across sectors. Winners and losers are being reshuffled. This isn't risk disappearing, it's risk moving. That's the real meaning of rotation. Don't be fooled by surface-level calm. Hey everyone, I'm Peter. One sentence sums up this market. This is not a trend market. It's a time-dragging market. The more impatient you are, the easier you get chopped up. Discipline is what gets you to settlement. This isn't about bottom fishing, it's about survival. Today, I'll walk you through the key levels and risks in plain language. Ignore the noise, follow the plan. Let's get the numbers straight. On Tuesday, the S&P 500 closed at 6,800.26, down 0.24%. The Dow closed at 48,114.26, down 0.62%. The Nasdaq finished at 23,111.46, up 0.23%. The S&P repeatedly tested the 6,800 area and bounced, showing support below but fading momentum above. This tells you space is tightening, more digestion than direction. That leads to a clear conclusion. Short-term action is weak, but the medium-term structure isn't broken. As long as we don't decisively break lower support, bulls are resting, not surrendering. If bulls are wrong, they wait. If bears are wrong, they get squeezed fast. That's why this isn't a great spot to press shorts. Levels matter more than opinions right now. You can see it in the candles. Indecision everywhere. Rallies get sold, dips get bought. Certainty is missing. Capital isn't fleeing. It's reducing exposure to crowded trades and reallocating toward areas with clearer payoff paths. If you're still viewing the market as all up or all down, this kind of tape will punish you. High-level markets are defined by separation, not unity. That's why I keep saying shorting here has worse risk-reward than staying constructive. Not because upside is guaranteed, but because downside has buyers. The smarter play is waiting for pullbacks into structure, improving entry quality and survivability. Save your ammunition for real breaks or confirmed expansions. Noise trades drain accounts faster than bad ideas. On the macro side, the theme remains cooling without stalling. Data isn't strong, but it isn't collapsing. That's why markets won't panic sell. Risk gets managed through rotation instead. Cyclicals, defensives, and selective growth all take turns. It feels chaotic, but it's controlled risk management playing out under the surface. Translated into trading language, bad news can hit price, but it struggles to create trend. Trends require tightening liquidity and collapsing earnings together. What we're seeing instead is repricing. Uncertain payoff models lose valuation first, while steady cash flow holds up. This is about sorting, not liquidation. Separate assets by balance sheet and execution, not by headlines. Rates provided a temporary cushion. The 10-year Treasury yield slipped toward the low 4% area on Tuesday, easing equity pressure but failing to ignite a new trend. Rates are the master valve. If they stay contained, the market grinds. If they reverse higher, valuation pressure returns quickly. Treat yields as your primary risk gauge. That's why I don't trade predictions. I trade conditions. I watch support integrity, rate direction, and volume behavior. If those don't break together, volatility stays contained. If they do, risk gets cut immediately. Rules beat feelings, especially in grinding markets. The simpler your framework, the better your execution under pressure. Valuations are elevated, but expensive doesn't mean imminent collapse as long as earnings grow and the economy holds. Time and profits can absorb valuation. The real danger is high valuation paired with weak earnings and crowded positioning. Right now, this feels more like compression than collapse, valuation being digested, not detonated. Sentiment matters too. Many investors aren't wildly bullish. They're underinvested in cash because cash keeps losing purchasing power. That makes markets more sensitive to shocks, but not structurally broken. Build positions that allow adjustment. Risk management should exist before drawdowns, not after headlines hit. Tech is clearly diverging. The Nasdaq can hold up because certain weights remain firm, but AI infrastructure and high multiple stories are cooling. The market is no longer pricing imagination, it's demanding conversion. Spending without payoff gets punished first. Leadership will belong to companies that can turn investment into revenue. Not all AI exposure carries the same risk. Cash flow structure, customer concentration, and payback speed matter. Emotional selling creates mispricing, but only if you can distinguish durable models from narrative-driven ones. Ask simple questions: how do they get paid, when, and with what margin? Answers define valuation. This week's key sentiment gauge remains Tesla. Its role isn't fundamentals, it's narrative and emotion. As long as high volatility, story-driven stocks hold up, capital hasn't exited systemically. If sentiment truly breaks, these names fail first. Tesla's behavior tells you more about risk appetite than most indicators. Think of Tesla as a thermometer. When it holds, emotion remains alive. When it loses momentum on volume, defense matters. I don't trade it for value, I watch it for signals. Market turns often show up in sentiment leaders before they hit indices. On individual names, CRWV continued to weaken, trading near the upper 60s. This isn't AI failing, it's leverage and capex being repriced. Markets are penalizing fragile funding structures first. The deeper it drops, the clearer the message. Expansion without balance sheet resilience gets discounted aggressively. If you touch names like this, rule 1 is don't catch falling knives emotionally, wait for volume contraction and stabilization before testing size. Otherwise, you're holding a volatility amplifier. Structure first, patience second. Sheep isn't a catalyst, stability is. PayPal fits the cheap but not urgent category. Trading in the low 60s, fundamentals are improving, but the market wants proof. This is a name that rewards patience, not anticipation. Today's market pays for certainty, not hope. My execution plan is simple. Don't size aggressively inside the range. Heavy exposure is reserved for confirmed breaks. You can trade tactically, but always with defined risk. This market rewards patience and punishes stubbornness. You don't need every candle, you need a healthy account. Sector rotation continues. Cyclicals and small caps attract trial capital due to soft landing optimism, but expectations still lead reality. That creates choppy advances, not trends. Treat this grind as positioning digestion. Watch volume and rates, not headlines. Final framework: as long as key support holds, treat weakness as rotation, not collapse. If support breaks, reduce risk immediately. Wait for structure to confirm before pressing. Tell me, are you waiting for the breakout or trading the range? Stick to structure, and this grinding market becomes manageable.